Hi, I'm in New York City at the airport. I'll be here for a few days. Let me talk for a moment about something called step-ups. I've been talking a lot about balances and how they affect our reporting process. There's an interesting correspondence though where we can add balances together to get to a different result. If the attributes we want to report by are stored on the balance, or the balance is posted by a particular set of attributes, and the balance we want to report on is at a higher level, fewer number of attributes, those attributes or can be a summarization of a few of the balances that are done elsewhere, it creates the ability for us to use a concept called step-ups. The step-up concept allows us to get rid of the transaction detail because we have posted the balances, but because they're lower level balances, we can add them together and still not destroy the ability for us to get to all the other kinds of balances that are interesting to us. Let's use an example to explain step-ups a little bit further.
Okay, for our example, let's use an example of someone selling and buying a house. So let's say that we had these transactions. Within the month of July, we had the home sale agreement. We then was followed by an appraisal. There was a down payment and a mortgage as we closed on the home. And then in December, there was a tax appraisal. If we were to record all of these transactions as individual transactions, they would create their own individual balances. And we think of each one of these things as independent when we don't use step-ups. The appraised value is independent from the mortgage value, is independent from the equity, is independent from the tax value. The step-up concept, though, we find the relationship between these things and define that relationship in the way we store the balances. So, for example, we could store the mortgage as the $118,000 mortgage. We could also record at about the same time the $10,000 down payment. We could also then store the appraisal value of that of $6,000 above those two values. When it gets to December, we could recognize that the tax appraisal is below that at negative $2,000. That would be called a step down. Step ups and step downs are equivalent. So if we go this route, then from these set of step-up balances that are recorded on the top of this slide, we can calculate all of the bottom balances that we want to. The home sale value would be $128,000, which is 118 plus the 10. The total appraisal value would be $6,000 plus the $10,000 plus $118,000 to get us to $134,000. And the total tax value would be $6,000, $10,000, $118,000, negative $2,000. Thus, by defining the relationship, and when we do the query process against these book code values, we can create, at reporting time, any one of these potential values that we need. Of course, if we don't use step-ups, there's some portion of the value that is shared among these different balances. And that portion of the value should be reconciled in some way to make sure it's synchronized. Whereas if we apportion the balance in a step-up process, then our adjustments and our use of those balances are determined to the specific nature of the balance as opposed to the general nature of the non-stepped-up balance.